Hello friends, welcome back to my channel, The Bulletproof Life. My name is Ronke Odewumi and I'm delighted to have you here. If you're new on here, I talk about budgeting, saving, investing, becoming debt-free, and building a bulletproof life, a life that's secure from failure and financial setbacks. So let's get right into today's topic.
So today, guys, I'm going to show you how to invest using the Vanguard platform. This is a video I have promised you for a long while, and I'm just coming through with it today. So you're seeing my computer screen, and I'm typing in the name of the investor company, and it's Vanguard Investor. That's what you need to type into Google. And then you have it. It's going to come up as vanguardinvestor.co.uk. So let's go to the Vanguard website. Vanguard Investor platform is an investment platform which you can use to buy a large number of investments. One of the benefits that Vanguard Investor website offers is that the investments on there have low fees. So Vanguard is considered a low-cost investment platform. So if you come here to invest, you are going to avoid that fundamental mistake that a lot of new investors make, and that is paying high fees. So we are now on the Vanguard website, and I'm just going to run you through it very quickly. First of all, you have here the offerings on the website. So on here, they have a number of funds which you can buy. So Vanguard is a great place to buy funds, mutual funds and index funds, active funds and managed active funds and passive funds. Now, the beauty of Vanguard funds, or the beauty of any fund, is that it allows you to invest in a large number of equity without you having to put all your eggs in one basket. So your funds, if you buy an equity fund, is invested in different equities. That's different shares of different companies. And if you buy a fund that's invested in bonds, then you are getting to loan out your money to large organizations and governments across the world, depending on where the bond is invested. So here, what we offer on the Vanguard website is showing you the different funds that Vanguard offers. And I'm going to be going through all of them one by one. So they have a full list of funds, which shows you all the funds at once. And then they have something called life strategy funds. And then they have target retirement funds, which are designed for you to plan your retirement. The life strategy funds are also designed to go in line with different life strategies, with different plans or goals for your life. And then we have the index and active funds, the index funds being passive funds, and then the active funds being funds that are actively managed by fund managers. And then you have the ETFs, which are exchange traded funds, very similar to mutual funds, except that they're traded on the stock exchange. And the exchange traded funds can be actively or passively managed. Just to say to you again, index funds are funds that track a specific index, such as the FTSE 100 or the FTSE 250. Now, in addition to the funds offered on this platform, Vanguard also offers different kinds of accounts which you can open, and that depends on what you want as an investment goal. So you have the Vanguard ISA account, which is basically a stocks and shares account. You can only put money into one stocks and shares account per year, and you have an allowance of £20,000 for this financial year, which is spread across all the different ISAs that you can have. So then you also have the Vanguard Junior ISA, which allows you to make stocks and shares investments for children below the age of 18 that are your children or who you are guardians for. Now, with the Vanguard Junior ISA account, you have an allowance of £9,000. That is how much you can invest per child. And both the Vanguard ISA and the Vanguard Junior ISA are tax saving accounts, because whatever profit or growth you experience on your investments in these accounts are tax free. In addition to these accounts, Vanguard also offers a Vanguard General account, which is not a tax saving account, but is an account that allows you to buy investments on this platform. It doesn't have that tax bracket or tax saving abilities of the Vanguard ISA and the Vanguard Junior ISA. So these are an account you can put money in. Once you have maxed out your Vanguard ISA, then you can put money into your Vanguard General account, especially if you are somebody, or if you are somebody who doesn't live in the UK and so you cannot have a Vanguard ISA or a Vanguard Junior ISA, you can have a Vanguard General account to invest with. Then you have the Vanguard Pension account, which is a SIP, it's a Vanguard Personal Pension, is a self-invested personal pension, which allows you to make investments towards your own pension. Your Vanguard Personal Pension account is an account which once you put money into it, you are not able to take out that money until you are past the age of 55. So please bear that in mind. You can also transfer an investment account here if you have it somewhere else on another platform. You can transfer a pension, and on here you have their fees and charges, which is the first thing I've opened. As you can see, they have low fees. Fees are clear and they ask you to open an account. There's an ongoing cost of just 0.2% on average, and a low account fee of 0.15, which is capped at 375 per year for accounts over 250,000 pounds, which means on your account you can never pay more than 375 per year. So it's very good fees, very competitive fees, and all of that. They've also given you an example here so that you can understand the kind of fees you will pay if you invest 20,000 pounds in a life strategy fund, which is 60% equity, 40% bonds. It's estimated that it will cost you £82 per year. That is really low fees. It's an estimate, so it's not a definite you will pay 82 pounds, but that is an estimate of how much you are likely to pay. So, and your fees are split into account fees, which are ongoing, and then the fund management fees, which are determined by the kind of funds that you buy. And that comes together with your account fees to make your total cost of investment. As I said, the account fee is a low one, is the 0.15% per year, very low. And then you have your fund management fees. Now, your fund management fees are automatically taken from your account or from your fund that you buy, from the returns on the fund before you get the returns. So it's not like you have to pay it separately. It's factored into your funds. But I just wanted to quickly run you through that fee setup before we go into the different kinds of accounts that you can have and kind of funds that you can buy on Vanguard. So as you can see here, there are no charges for all sorts of activities, transferring out, switching funds, withdrawing money, closing your account, no charges at all. Vanguard is very, very price friendly, and that's why it's a good one for anyone who wants to invest and doesn't have a lot of money. So let's look into the funds that they have. Let's start off with the Life Strategy Fund. Now, the Life Strategy Fund, there are 5 funds that are split across different equity levels based on risk. And one thing I always say is that you should always know your own risk level. You should know how much risk you can bear, because that will determine what kind of investments you buy. Now, in this particular group of funds, you can have it as a 20% equity fund, which means only 20% of your money goes to shares, 80% goes to bonds, which makes it much safer. As you can see, the risk level is 3. And then you can have 40 or 60% equity, which means that's how much equity your money is used to buy in terms of shares, and the rest goes to bonds. Again, the risk level goes up a little bit to 4. And then you have the ones that I particularly like, which are the 80% equity fund and the 100% equity fund. They are considered aggressive investing because 80 to 100% of your money goes to equity, and that's why their risk level here is 5, which is quite high. But for me, that is a fund that is quite aggressive. Now, if you look at the performance of a 20% equity fund, which has low risk, the performance is rate of return is something between 1.45% and 8.28%. That is the maximum rate of return it's had in the last 5 years. Now let's go. That's for a fund that's low risk and cautious and all of that. Now, if you go to a moderate fund, if you view the performance of this moderate fund, as you can see, you are benefiting from the fact that it's more risky because it's going up to 18.97%. But let me show you something interesting. That's a -3. That's a loss. So that is possible once you go out of the realm of cautious investing and you go into something that's a little bit more risky. You are more likely to lose money. But you can see it went up to 21.5%. percent this year. So it's a good fund in that sense, if you don't mind a little bit of risk. Now let's look at the big boys, the very aggressive funds. Oh my gosh, look at that. It's 33.7%, and at its lowest is 2. So you can see that even the aggressive funds are better than the moderate. So it goes after that quote that says go large or go home. So it's better you do the aggressive fund or you stay with the cautious one, not to lose money, because as you can see, there's no loss on the aggressive and there's no loss on the cautious. The moderate one is actually the place where you lose money. So you know that thing about being lukewarm. You're either going large or not going at all. So I'm a big fan of the aggressive fund. As you can see, it's gone up to 33% in 2016, 2017, and right now it's doing 15.54. So not as good as the moderate fund this year. So your investment strategy is impacted by your risk appetite. So this is what the life strategy looks like. That is the kind of fund, and it's a blended fund that Vanguard offers, that allows you to invest across both equity and bonds. Yes. So life strategy fund, mixture of shares, equities, and bonds. That's basically what it is. And this page breaks it down further, what I just explained about it being a mix of shares and bonds, and it's medium to long-term goals, 5+ years. I always say that you need to invest for at least 3 years for you to reap the benefits of your investment. So that is one thing I'm repeating here again. You need to invest for at least 3 to 5 years. This fund also has low charges at 0.22. So I quite like it. It's a good way to put away money for the future. Now let's go back and look at the other kind of funds that Vanguard offers. Target retirement funds. Now, these retirement funds are designed to work with your retirement year. So if you're planning to retire in 2020, or they've said target retirement fund 2015. So this one is a fund that was set up for people who wanted to retire in 2015, and this one was set up for people who wanted to retire in 2020. So as you can see, the reason why these dates have been put there is that once you are closer to your retirement date, you want to take less risk with your money. So there is more of it invested in funds for people who are close to their retirement date. So if you see this 2015 bond fund is more invested in bonds and lower risk than the 2021, which is now 51% in bonds, less bonds, more equity. And as the retirement date is being pushed out, the investment in equity increases. It becomes more aggressive, because the idea is to invest aggressively for you at first and then reduce that aggression as the years go by. So for somebody like me who knows that my retirement is probably 25 years away, I'm more interested in the Target Retirement 2045 fund, which is more invested in equity, 79% equity and 20% bond. That is more in line with my risk appetite and my retirement plans. 2045 is closer to my retirement age, not necessarily when I want to stop working, but that's like my retirement age. That's the age when I'm going to be able to say, actually, I don't want to do any more work. You might go for something even more aggressive and say 2065, 80% equity, or 655, which is also 80% equity. And if you view the performance of this fund again, it's doing great in the sense that it's gone up to 28.57 this year. Very aggressive investing. However, it also had a loss of 6.41 last year. But you don't mind, because it's a fund you're planning to put your money in for a long time. So this is a fund that you want to put money in for at least 10 years. You want your money to work for you hard. And so you don't mind a bit of aggressive investing, because whatever is lost in 1 year will be covered up by the other years that your money stay in this fund. Now let's look at, for example, the Target Retirement 2035 fund is an accumulation fund, and it's talked about the fact that it has a risk level of 4. You can invest in it with your ISA. There's no exit charges. You can exit anytime. They've talked about the fact that the fund is an actively managed fund. It's doing well, except for last year when things went a bit funny. And if you've put 10,000 in it in 2016, you would have about 15,863 this month, which is, over 50% growth in 5 years. So not bad at all. But again, it's a relatively safe fund because a lot of it goes to bonds. So that's the Target Retirement 2035 fund. But if we go back to something that's more aggressive, and I'm going to go with the 2050 fund. Yes, it's a more aggressive fund. And you will see that it's 28.59. And if you've put in 10,000 in 2016, you would have 16,452 now. So it's done better than the 2035 fund I opened up earlier. Now, Vanguard also provides other information about the fund. It looks about the historical price. How much has it been? So the price hasn't changed since 2015 when it started much, but look, sorry, it was started in 2015, but the price, this is the price for the last 5 days that we've been looking at it. 52-week low means what was the price a year ago? What was the lowest price it was sold at a year ago? And what's the highest price, which is right now? So you can see the change in price. It's a fund that's growing and increasing and doing better. Vanguard kindly also tells you how the fund is allocated, what your money is being put to. And as you can see here, your money is spread across equity index funds, US equity, world equity excluding UK, then FTSE UK, then global, emerging markets, North America, developed Europe. It splits your money quite nicely. So you don't have to worry about individually allocating your money to different things. Once you put your money into this particular fund that they've set up, this Target Retirement Fund, it helps you split your money across a large number of index funds and equity funds and all of that. And it's a really good split. A large percentage of your money goes to the US equity, FTSE UK, and developed world excluding UK, which means you are literally invested across the globe, including emerging markets. You're invested across the globe, which is fantastic. It's a really great way for you to diversify your investments. So I've talked about the Target Retirement funds. The other thing I want to talk about now are the index and active funds that they have. They've got 37 funds in this particular pot, and this fund is split across different locations. They've got a global fund, which invests your money globally and has a risk level of 4. They've got equity bonds across Europe, the global, UK, they usually have Japan, Asia Pac, US, and emerging markets. These are the funds that you can buy under this index and active fund pause. And they will tell you if a fund is an index fund or if it's an active fund. So for example, under the Europe fund, they've got 2 funds. They've got an index fund and then they've got an active fund. Under the global fund, they've got all these index funds, and then they've got the ones that are active funds. They're not index funds. And then they've got the small cap index fund. So they've got a mix of both index funds and active funds. Same applies to the UK, is a mix of index. The UK has is a mix of index and equity funds. I was going to be surprised if they had just index funds here. So they've got the active fund, which, as you can see, has a higher fee of 0.45 as compared to the index funds, which have lower fees because they are not actively managed. They are passively managed. That's one thing you need to be aware of. Index funds are usually passively managed because they're tracking a particular index. So they tend to have lower fees as compared to active funds. So that is what you have here under this list of index and active funds. And one other way to choose is to look at all the material they provide about each of these funds before you buy. You need to read through this material and be sure that you understand what they're telling you before you put your money to it. The other thing you have here is exchange traded funds. Now, exchange traded funds are funds that are traded on the stock exchange. A lot of these funds, you can get your money put into them easily by simply buying a life strategy fund or a target retirement fund. That way, you just get all your money put into one of these funds. So what you have here are exchange traded funds. For Europe, you have this one, which is developed Europe excluding UK. So developed Europe means countries like Germany, France, Norway, Sweden, and so on. And then if they have developed Europe, but does not exclude the UK, that means it includes the UK. And then they have Germany all cap, which is the biggest companies in Germany, which is like the top 300 companies in Germany. That's what you're investing your money in. And then the global funds are also available for you to buy as exchange traded funds: FTSE All World Dividend Yield, FTSE Developed World. And then you have the UK, which is FTSE 100, which invests in the top 100 companies in the UK, the biggest 100 companies on the stock exchange, on the London Stock Exchange. And then you have the FTSE 250, which is the next 250 companies after that first 100 companies. And then you go on to Japan and then Asia Pac. And these exchange traded funds really allow you to invest across the world. Now, there's something called fixed income bonds, and these are fixed income investments which allow you to invest in bonds. And they are called fixed income bonds because they tell you right from the beginning how much interest you're going to get on your money. And they're very safe because they are bonds. And that's the beauty of bonds, because you're basically giving a loan out to either a company or a government. If you look at the Europe bonds, you have the EU corporate bond, which means you are giving a loan out to companies in Europe. And then for the EU Eurozone government bond, you are borrowing out money to governments across Europe. And if you let me open up the EU Eurozone government bond, it's got 396 bonds in here. The prices are low, the charges are low, 0.07%. And the portfolio data should tell us a little bit more about it. Let me see. I'm trying to see what securities he holds. Yes, so when you buy this particular Eurozone bond, you're borrowing out money to the Italian government. So you've got Italy here, you've got French Republic government bond, you've got Spain, Dutch, yes. So these are the key countries you're basically loaning your money to. That's where your money is going. And there are strong companies, there are Europe large countries. I keep saying company. There are Europe large countries. So these are the things that make bonds very, very safe, because if anything happens to the country or company that you've given your money to, as a bondholder, you are settled before they settle a lot of other debtors or other people that they owe money, creditors rather. So they settle you first. That's what makes bonds very, very, very safe. So when you buy the bonds, you are investing or you're giving a loan to a company or a government, and it's very, very, very safe because it's a loan. So you don't really benefit from the growth or profits of that company. Your interest rate is determined at the point of purchase. So nothing is changing about that. You're not going to wake up tomorrow and say, because we've done well, we've had a good year, we're going to give you more. It doesn't happen like that. And then with UK bonds are called gilts. So if you buy the UK gilts, yeah, basically borrowing Bojo money to run his government. Same with the US. You can buy US corporate bonds. You can buy US Treasury bonds. Now, a US corporate 1 to 3 year bond is a bond that ties you in for that period of time. So if you're buying a 3-year bond, it ties you in for 3 years. That's how long your money stays in there. And then you've got the USD Treasury bond. You're borrowing Biden your money to run his government. And then emerging markets, you are really borrowing your money out to governments in Africa and Asia. So these are the kind of funds you can buy on the Vanguard platform. They also provide some investing education. I always advise people to read up on this place on learning about investing, choosing your accounts, choosing your funds, and using a pension calculator. All of these things are there for you to read up on. So we go back to the home page. Now that we know what they have to offer, it's time to open an account. So you can go back to the home page and you can open an account. So I always say to people, if you don't have a stocks and shares account anywhere else, the first thing you want to open is a stocks and shares account here. So yeah, this account is strictly for UK residents. So if you're not resident in the UK, you won't be able to open it because they're going to ask you for things like your national insurance number. They're going to ask you for a UK address and all of that. So I'm trying to open one. So they want you to pick an investment, which is an interesting way for you to start. They want you to choose your investment before you even open your account. So let's say we pick a life strategy investment of 60%. So it's a £500 single payment and then a regular payment of £100. And then I use that to open my account. So they don't want you to open an account that's empty. They want you to start it with some money. So some platforms allow you to just open the account empty, but these guys here are asking you to put in money to start out. So as you can see, they want you to put in your details. You're going to need your NI number, and you're going to need to then tell them where you live and put in your address and all of that. When were you born, because you need to be over 18, and then you go ahead and open that account. So I hope that sharing this video has helped you a bit with starting your journey on investing and using Vanguard platform to invest. If you have any questions, please feel free to drop me a comment in the comment section. Please feel free to reach out to me by email at ronkeodewumi@gmail.com to ask me questions about investing on the Vanguard platform or any other platform. If there's any other platform you would like me to show you on here as a screen record, please drop me a comment. Let me know. If you haven't subscribed to my channel, please do it by pressing the red button on your right. Please press like on this video so that YouTube can show it to other people like you. I love hanging out with you here on Mondays and Thursdays. So I will be back on Thursday with another video. Until then, you take care of yourself and keep living that bulletproof life. Bye-bye.